Well, before you get started, let me just briefly tell the group that Harlan's been in the mortgage industry for over 20 years. And frankly, he's worked with all types of loans. His specialty and favorite has always been working among the 62 plus age group and has been very successful himself in that area. Currently, he is the reverse mortgage director at Fairway Independent Mortgage Corporation. And I would encourage you to stay on, listen to Harlan, because what I have learned is that you get a very different perspective when Harlan does a presentation. So I'm going to be quiet because I think you will enjoy hearing from Harlan.
Well, thanks for the opportunity. And I want people on this call to be, we've only got, 15, 20 minutes. So I want you to be very skeptical and because your clients will be, and your wives or your husbands will be if you tell them about this later. I know when I told my wife, when I came home from the seminar 18 years ago and told her that we were going to do a reverse mortgage when we turned 62, she said, "Oh no, we're not going to do that." And here we are at 61, and next year we're going to be doing one, and she's actually excited about it. So but she wasn't in the beginning, and I can understand that because it's something that is, I don't know, but the fact is that 90% of your clients, 90%, not a few, but most of your clients would be better off if they did a reverse mortgage the day they turned 62, even if they have plenty of money, especially when we're looking at the preparation for long-term care. I've been there myself personally. My parents used the mortgage money specifically to take care of their long-term care, to be able to stay at home instead of going to a nursing home. And I'm so thankful that they were able to do that. Long-term care costs are an incredible, huge number that scares the heck out of all of us. And we have a counteracting large number. We have $9.2 trillion sitting in home equity. We have some of our brochures talk about using your home to stay at home. And here's what's really weird. When you think about it, and I'm going to show you this graphic up on the screen really quick. I'm not going to go through a whole PowerPoint or anything, but I'm just going to show you a couple of slides. This graphic right here, think about this for a minute. Everybody makes a bunch of money in bucket one. These are 3 buckets of wealth. Everybody makes a bunch of money in bucket one. And that goes up to their top pre-retirement wallet. And then you try to save money, and we try to give you, as my investment advisor and my insurance agent, a whole bunch of money. And we try to put it in 401ks and stocks and bonds and life insurance and annuities and so on. But people are very busy sending us money in bucket 3, 32% of the average income of clients out there right now, 32% is going into bucket 3. They can't give you as much money because they're giving us all of that money. And so then when you get down to the post-retirement wallet, I was just talking to a financial advisor a few minutes before I came on, and he's got a client that's got $750,000 in their nest egg, most of it taxable, and only $30,000 coming out of bucket 1 because they decided to retire at 65 and 62. And they're still making payments of $2,500 a month to bucket 3 on their house. We can eliminate that payment and take it to 0 next month. Their last payment is November 1st. Now, the fact is, and give them more money out of their house. So think about it. When I give you folks money every single month that I make a contribution to a 401k or my life insurance or my annuity contracts, you guys are guaranteeing me a certain amount of money that I'm going to get back in the future. If I'm making that payment into a life insurance policy with a long-term care rider, an annuity with a long-term care rider, you're also guaranteeing a certain amount of long-term care that you're going to be paying me back for if I need it. Now, isn't it amazing and somewhat strange that when people give us 32% of their income, yes, 32% of their gross income before taxes, they don't ask for it back when they get to be 62 or 63 or 65 or 70. Isn't that a bit strange? If I give you a bunch of money and any of your clients give you a bunch of money, they expect it back. But when people put money into home equity, it is very odd and very strange that they just think it should stay there and it should go to their kids. Well, why shouldn't the 401k money go to the kids? Why shouldn't the money in the savings account go to the kids, or their social security go to the kids, or their pension? Maybe send everything to the kids. The fact is that the cheapest money to use when it came to mom and dad had a stroke at 86. The mortgage was in place and there was $300,000 sitting in that mortgage, which he never used because he didn't need it. Remember, I said 90% of your clients should do this the day they turn 62, 90% plus. In some cases, with some advisors we work with, it's like 99%. But it's always the vast majority of your clients should do this, not because they need it. Dad didn't need it when he did it. But when dad had a stroke, he needed the rainy day money. And that's what I told him. I said, Dad, you don't need the money today, but just get that mortgage in place. So if you need it, it's there. And he said, Harlan, we're small time Wisconsin farmers. We don't spend that much money. We don't even go out to eat on Friday night and have fish fries because we got better food at home and we don't need the money. I said, I know you don't now, Dad, but you never know. And when's the best time to borrow money? If you ask anybody that question, and just about anybody can answer that the same way, when you don't need it. It's a great time to borrow money when you don't need it. And it's a great time to borrow money when the interest rates are low. Well, then why don't most of your clients over 62 who don't quote unquote need the money, why don't they just at least set up a line of credit with a guaranteed line of credit? You say, well, they already have a line of credit at the bank. Those can go away in a second. Don't let your senior clients, please don't let your senior clients just get a regular line of credit to fund things in retirement. Because when dad had his stroke and he wasn't able to talk or walk or do anything by himself anymore, and he was confined to a wheelchair, you don't go out and get loans then. And most lines of credit go away when things get tough, and especially when the market decreases the values. And that's exactly what would have happened if dad would have had just a regular line of credit. Reverse lines of credit are specifically guaranteed that they're available no matter what happens. If you get sick, if the value of your house goes down, if the market crashes, no matter what happens, you still are guaranteed to be able to use that money from a long-term care situation. Now, when dad at 86 had his stroke and mom's Alzheimer's kind of went over the cliff because he's the main caregiver, what happened? Well, he could pull money out of his IRA to the tune of $8,000, $10,000 a month. He can't go back to work and pull money out of bucket one because he can't work anymore. So if he starts pulling $10,000 a month, $120,000 a year out of his IRA, what happens? And he didn't have a big life insurance contract. He didn't have long-term care. And so if he pulled money out of there, it was going to not only tax him heavily, but the market was doing well. Where was the cheapest place to get money? Out of bucket three. That money is 3%. Why would we not want to pull money out of bucket three? Doesn't that just make the most sense that you would take it from the cheapest place? Now, many people don't even think about it. I was talking to some long-term care givers that own long-term care companies, and I said, why don't you guys ask us for money? Why do you go to the investment advisor and ask for the money? Because people have hundreds of thousands of dollars usually sitting in their house. Why would they not just take that and grab it? Doesn't that seem to make the most sense that you would pull money out of your house instead of pulling money out of bucket two? And they said, well, isn't that pretty expensive? Well, what's expensive taking money out of an IRA? Yes, it's expensive. I mean, it costs 2% of the value of your house to set up a reverse mortgage. So we understand that. Yes, that is expensive, quote unquote. But expensive compared to what? Expensive compared to pulling money out of an IRA, having a spouse go back to work, ask your kids for money if you don't have long-term care insurance. All of those situations go together that why would you not take money from bucket three? But over 95% of the time, people do not tap into bucket three, and they instead come to you and deplete their assets until they're broke in bucket two, and then they come and ask us for money. That just happened in South Dakota last year. 102 and 103-year-old couple did not want to go into a nursing home, and they took out a reverse mortgage so they could stay in their house because all of their other money was gone and a good share of their kids' money was gone. Their kids are in their 70s. Why do we look at reverse mortgages as a loan of last resort? Because when it comes to long-term care, the partnership between us and you should be like glue. It should be like hand in glove. We should be working together on this. Because let's back it up a little bit further. Let's talk about people in their 40s and their 50s looking at this same diagram. So I'm making a lot of money in my 40s and my 50s, and I'm putting it all up into my wallet, and I'm paying all of this money into my house, 30-40% of my income into my house. I have less to give you as an advisor. I can't buy long-term care insurance. I can't buy life insurance with long-term care riders. I can't purchase annuities because I'm putting all that money into my house. Many people are taking out 15-year mortgages right now and increasing their mortgage payments so they can pay it off faster and put more and more money into bucket 3. And why do they want to do that? Well, because they want to get rid of their payment. I'm going to get rid of my payment next year. Doesn't matter. I don't have to worry about how much is owed. I don't have to refinance and take it from 2,000 down to 1,500. My payment just goes down to 0 April of next year because I turned 62. So in the month that I turn 62, I can eliminate my mortgage payment. I'm done. I'm done making mortgage payments at 0. I can make them if I want. If I want to send money to bucket 3, I can. But why would I continue to do that when I can make sure that I keep sending money into my life insurance that's got long-term care riders, and I keep sending money into annuities, which will guarantee me income in the future? What do I lose? Well, what do I lose? Do I lose my house? No. I lose some equity in my house to the tune of about 3%. So I lose 3% in equity every single year. So if I owe 100,000, next year I owe 103, the year after that I owe 106, and so on. Does that matter? Because I'm gaining more in bucket 2 than what I'm losing in bucket 3. And so it doesn't matter. So I'm better prepared for long-term care. I can afford my insurance. I just had a client that came to me, and her husband had passed away. She's a widow. I hooked her up with a NAFA member, and she needed an annuity for income for when her husband's pension runs out in 10 years because she's very healthy. She wanted to have some life insurance to give to her kids from some of the money that she had got from her husband. And she also wanted to purchase a long-term care policy so that she wouldn't be a problem to her children. She was able to do all of those things because we took away 100% of her housing expense, because not only are we paying off her mortgage, we're also making sure that her taxes and her insurance are going to be paid for the rest of her life, because that will be coming out of the proceeds of the mortgage. So she gets rid of her house payment so she can afford to have long-term care insurance. I think it was like $8,000 a year. So she can afford to make sure that she's putting that money away into an annuity, and that she also has the life insurance that she wants for a legacy for her children. And she's still getting money from her pension as a school teacher. And we took care of, he's taking care of her 403B and her IRAs and all that sort of thing. By working together with our company as a mortgage lender and saying, hey, you don't have to pay us anymore. You can pay us a year after you're dead. That changed everything and made a dramatic difference in her life. And quite frankly, when her kids were on, her kids decided to do business with the financial advisor because they want to set up the same plan earlier rather than waiting until their 50s and 60s. They know the importance of investing now and working together with that advisor. There is so much that we can do together, because at Fairway, for example, we don't do any insurance or investments or any of that kind of thing. We strictly do mortgages. So we need you in bucket 2 to take care of the things that we are not doing when people send us money in bucket 3. Because when people send us money in bucket 3, guess what? We only give them one thing. We give them equity. We don't even give them cash back. We give them equity back. Now, if I came to you at 62 years old and I said, Mr., Ms. Financial Advisor, I'm going to give you guys $1 million to manage for me. Will you do that for me? And of course, you'd probably say yes if you're taking on new clients, which I assume most of you are. And then I'd say, but I'm not going to give you all of my money. Excuse me. I'm going to keep about $500,000 and I'm going to invest it myself. And I'm kind of do it yourself investor. And I'm going to just invest that money myself. And you might say, well, that's okay, but I need to know what you're going to do with it. So could you tell me where that $500,000 is going so I can plan what we do with your other million? And I'll say, I'm going to put it into an illiquid investment that will never give me more than a 3% rate of return. And hopefully my kids will get something at the end. I have no idea how much they'll get at the end. You'd say, Harlan, we can do better than that. I don't know if that's a good idea if you're that good of a do-it-yourself investor. But if I turned around and I said, well, here's the deal. I'm going to invest it in my house. I'm going to pay my house off, and I'm going to pay cash for my house. So it's free and clear, a $500,000 house. I'm going to own it free and clear. Then all of a sudden, oh, okay, well, that's okay. No, it's not okay. Because if I put all of that money into my house, I literally invested into a 3% investment that gives me less than a 3% rate of return and is completely illiquid. Is that a wise thing to do? No, it's not. But millions of people do it because their loan officer told them that it's a good idea, and their financial advisor and their attorney and their brother-in-law. Everybody told them it's a great idea to pay off your house. But is it? Does it make sense? Why? Why would we be doing that? It is up to you and up to me, up to our 3,500 loan officers at Fairway, and up to the 25,000 NAFA members to tell people the story that, hey, if you want to make sure that you have life insurance and long-term care and you have guaranteed lifetime income, we need to work together to make that happen. It's critical that we properly work between buckets 2 and bucket 3, and then what their Social Security is in bucket 2 and how they're going to be handling their pension. Now, Mike asked a great question. How does Fairway compare to other firms? Ultimately, you're asking us to give you our clients and trust your services. I know that this perspective is to illustrate the concept to agents, but for those of us who use this to help out clients regularly, why Fairway versus a jumbo or other? I'm not sure what you mean by jumbo, but this isn't just about you giving us your clients. Understand that a majority of our clients, we get 15,000 new clients a month. Fairway is a very large company. We have 600 offices, and we'll do about 80 billion this year in mortgages. We don't do finance or insurance. You want to get to know our people, because just like that client that I referred to, that NAFA member, they got a life insurance policy, they got an annuity, and they got a long-term care policy. And I think it was 2 IRA rollovers, plus 2 of their kids started investing with that financial advisor. So this is something that the reason that you would want to trust Fairway is, first of all, we're a national sponsor of NAFA. We work very closely with a lot of initiatives. I'll be at the leadership conference in December. I'm very concerned about us getting this story out in retirement and helping people. Secondly, we are at the grassroots level. I was just in the state conferences in Washington, in South Dakota, in Texas, and have more of them planned this year, into next year. The issue is that by working together, it's not that you're giving us these clients, we are giving you the money to fund the things that your clients should have. And that is something that you can't find elsewhere. Maybe there's some smaller companies here and there that understand things as well as we do and are as oriented toward financial planning, but no one on a national stage. You're not going to get that from Rocket Mortgage. You're not going to get that from Wells Fargo. Wells Fargo will try to get your clients. They'll try to move them over to Wells Fargo Wealth Management or Bank of America or US Bank Private Wealth Management or whatever. So it is critical that we work together for the betterment of the clients. I'm not telling you this so that we can sell more mortgages. I'm telling you this so that we can change more lives of our mutual clients out there. We need to. If we don't change the lives of the clients, how is this whole long-term care thing going to be paid for? I mean, when we do this, for example, I'll show you this slide right here. I'll just jump ahead a couple of them that's coming right up here. When we do this, we protect the client's house and we install a faucet on the side of the house. So against asset protection, against any of the Medicaid liens, we put a mortgage over the top of the house, big mortgages, so that we can create access for cash that never has to be paid back until a client passes away. none of the money that dad owed or my wife's parents owe or my sister owes or that I will eventually owe has to be paid back during our lifetime. We can if we wish. If we want to sell the house and move somewhere else or whatever, you can pay it back with the sale of the house. But most of the time, what we're going to be doing is making sure that we don't have a payment so we can use that money for other things, and that is protected and we have access to that cash to make sure that either A, we can continue to make payments for long-term care insurance or for life insurance with long-term care riders, or so if we can't qualify for that stuff anymore, that we don't have to draw from those investments in order to fund our long-term care. Because if long-term care costs $10,000 a month, there's an awful lot of money sitting, there's 9.2 trillion to be exact in seniors' houses over the age of 62. And there's a tremendous amount to be able to install that faucet and say, hey, use that instead of this. Let the annuity defer a little bit longer. Let the life insurance take time to grow. Let that cash value build, and don't take that away from the death benefit from the kids. So those are things that we can work together on. And by you talking to us, I come from a medical town. And when you've got 2 or 3 doctors working on you at the Marshfield Clinic in Wisconsin, is a big clinic, 800 specialists. When 2 or 3 of them are working on you, they all talk to each other. And they all compare notes and they look at each other's prescriptions and what they're giving you and what kind of treatments are in place. Now, if they don't talk to each other, what do you call that? Malpractice. Well, what if the accountant and the financial guy and the mortgage guy don't talk to each other? That's almost called normal. Is that right? No, we want to have a relationship between Fairway and the NAFA members that we can do the job that is necessary to make things happen. And by the way, I know that some of you have to go, and I'll just flip ahead to this. If you want to contact us for some more questions, simply contact me at these. There's my email, and Fairway Reverse we have a lot of videos and so on that we can show to be of help to your clients, and make the difference from there. Because by working together, we can obviously make a huge difference in our clients' lives. Because if we don't work together, you do your thing, we do our thing, and we don't really talk to each other, we can't multiply our knowledge about what we can do. And long-term care is an incredibly scary thing out there. And by the way, I write about some of these things in my book. If you would like a copy of the book that I wrote about home equity and reverse mortgage as a Cinderella of the baby boomer retirement, just let me know and I'll have one of our offices get it to you wherever you're at. Just send me an email from there, because we're not interested in selling books. We're interested in changing people's lives. We're selling mortgages and helping you with your products to be able to change the lives of your clients out there. Now, I realize that I real quickly just went over a very counterintuitive, concept, because a lot of people, I grew up going to mortgage burning parties back in the 60s with my dad. So I understand what some people think about that. But that's the situation that I want you to be very aware of, that I understand that this is a very different thing to digest. But if we're going to beat this whole long-term care issue, we have to look at other places to fund it. Only 5% of people have long-term care insurance. Why is that? Because millions of people have their houses paid off. Maybe if they didn't pay off their house, they'd have money to buy long-term care insurance or life insurance or annuities, so that they would be able to cover that. We're interrelated. Like I said, this is hand in glove, and they don't even know about it. We tell our clients about this. Don't get a 15-year mortgage, get a 30 and go talk to your investment advisor and figure out what else needs to be done on the other end. So it is absolutely critical that we work together. So please email me and we'll take a look a little bit more. Any questions that I know that we've only got a half hour and I wanted to go through things really quickly. Any questions that any of you have about this specifically? And just go ahead and type them into the chat box if you have any questions. And what I'll also, I'll keep an eye on the chat box. What I also want to show you, Kelly just said, we did this with my dad and it saved us. after his passing, joined the industry to educate about long-term care. So important. Thank you. Kelly, I'm sorry that your dad had to go through long-term care, but thank you for sharing that. I wish my mom and dad didn't have to go through Alzheimer's and strokes either, but it certainly made it much easier than what it would have been otherwise, because the money situation was taken care of. Thank you for sharing that.
Harlan, Harlan, I noticed that in the chat, we have various people asking for the book, as you suggested. Since it's not possible to save chats when you end the program, let me encourage you, Julie and Dorenza, to look at the slide that Harlan had up.
I just did it up. Sorry about that.
So, that offers you his contact information. I'm sure that if you email, they have offices everywhere, and he will have someone take care of getting it to you. And I would encourage all of you who are listening to this. This was one of our rapid fire sessions, a lot of information, important information. So if you would, please be sure to contact Fairway, and so you can get additional information. You can meet with someone and perhaps talk about how this would enhance your practice, your business. And with that, Harlan, I think on behalf of everyone who has attended, I would like to thank you for your time today and for a very insightful and interesting presentation.
Well, thank you, Carol. And I saw there's a few other questions there. Please feel free to email me, and I will be happy to answer any of those questions. We obviously ran out of time today. And I'll probably even send you a couple of little videos that answer that. We got like 50 2-minute videos with stock answers to some of these things. So I just appreciate the opportunity. We're fortunate to have people like Carol that understand this type of thing and that make the difference. And even though I'm only one person, realize isn't it refreshing to know that you'll actually talk to a loan officer who has a positive attitude about cash value life insurance and annuities and understands this stuff, that you don't have to try to sell them on the idea as well. Please feel free to contact us. By working together, our businesses will increase, but that's not the important thing. The important thing is that we will change the lives of our clients and make sure that they're more prepared if they have a long-term care event. So thank you so much, Carol, for all that you do. And thank you, all you NAFA members that are providing the products to save people's difficulties in their last years.
Thank you. And thanks to everyone for attending today. I hope that you will join us tomorrow for the Executive Leadership Roundtable, and I look forward to seeing you then. Enjoy the rest of your day. Bye now.
I know.